America just went blind. Not figuratively, not as a metaphor, literally, physically, operationally blind. This satellite image, taken March 2nd, 2026, confirms a direct hit on the THAAD radar at Muwaffaq Salti Air Base in Jordan. A $500 million asset, a cornerstone of regional defense architecture, is now a blackened crater. This is not a surprise. It is the precise scenario Elon Musk warned of, stating that unless dramatic changes are made, America will lose its next war badly. The math of asymmetric warfare is now being reconciled. This single event has triggered a cascade failure. In this briefing, we will analyze the crippling new cost-exchange ratios, the drastically shortened warning windows, and the capital flight signals that are already beginning to appear. Because this isn't just about one destroyed radar. It's about the fundamental strategic principle of eyes versus fists. You have just witnessed the eyes being taken out. Now, we must analyze what happens when the fists begin swinging in the dark. So, America's fists are swinging in the dark. What does this mean in concrete terms? It means the paralysis of an entire regional defense architecture. This was not a tactical strike. It was a strategic lobotomy. To understand the gravity, you must understand the mechanics. A missile defense system functions on a simple principle: eyes and fists. The ANTPY-2 radar, the asset now confirmed by CNN satellite imagery from March 2nd, 2026, to be a crater at the Muwaffaq base, was the eyes. Its sole function, to detect, discriminate and track incoming threats with extreme precision. The interceptor batteries are the fists, powerful but inert, waiting for a fire control solution from the eyes. Without the eyes, the kill chain is severed at its origin. Detection does not happen. Tracking does not happen. A targeting solution is never calculated. The launch command is never sent. The fists remain clenched, but they are useless. Now let's quantify the scale of this decapitation. The destroyed asset is valued between $500 million and $1 billion. The monetary cost is trivial. The critical metric is scarcity. According to US Army budget reports and defense analysts, fewer than 20 of these advanced radar units have been produced globally since the program's inception. Full replacement, manufacturing, and integration back into the grid requires, at minimum, a 5 to 6 year timeline and a deployment of hundreds of specialized personnel. For the next half-decade, this is not a gap. It is a vacuum. As the initial analysis stated, Iran did not hit the fists. They hit the eyes. It is the military equivalent of blinding a superior fighter and then simply waiting. But this strategic paralysis, this induced blindness, is only the first phase of the true strategy. It was the prerequisite, designed to enable the second, more decisive phase. The real war isn't about fists and eyes. It is about mathematics. It is a war of economic attrition, a death by 1,000 cuts. We must now analyze the brutal, unsustainable cost-exchange ratio that this blindness has unlocked. A ratio that, in some engagements, is already approaching 70 to 1. That 70 to 1 ratio is not a hypothetical. It is the tactical reality forming the core of this economic attrition warfare. With the defense network's eyes removed, the second phase begins, bleeding the system's finances until it collapses. The core of the strategy is the catastrophic cost-exchange ratio. According to New York Times analysis, Iran's Shahed 136 drones, costing between $20,000 and $50,000 each, are being countered by US Patriot interceptors that cost between $3.5 to $5 million per launch. In these engagements, the cost ratio is as high as 70 to 1 in favor of Iran. But the math gets worse. A CSIS report clarifies that against our premier assets, like a single THAAD interceptor valued at approximately $12.8 million, the cost exchange ratio against a $20,000 drone skyrockets to over 640 to 1. In this type of conflict, the advanced weapon becomes a liability if its cost is unsustainable. The victor is simply the one who can afford the fight the longest. Iran is winning the math. This is a deliberate, calculated money game. The current waves of attacks are intentionally low-grade, designed with a single purpose: to force the expenditure of America's most advanced limited stock interceptors. The real weapons here are the ruinous cost ratio and the crippling replacement timeline. US production capacity for these critical interceptors is severely constrained, ramping up from just 96 to a projected 400 units annually. Iran can produce thousands of drones in that same time frame. Even former Secretary of State Blinken has publicly acknowledged that our interceptor stockpiles are running dangerously low. And here is the critical insight you must internalize. Iran is achieving this catastrophic bleed-out, while its real arsenal, its most powerful ballistic and cruise missiles, remains in reserve, untouched, waiting for the defense system to fully bleed out. We've broken down the catastrophic math of this attrition war. For the strategists and engineers in our audience, beyond the interceptor costs, what's the single biggest second-order vulnerability you see in this model? Share your analysis in the comments. But this slow financial bleed creates a far more immediate and lethal problem. Pentagon insiders have sent a distress signal that is being ignored in public discourse. The loss of the forward-based radar has done something terrifying to our defensive timeline. The standard 20-minute missile warning window for the region has now collapsed to less than 120 seconds. 120 seconds is not a warning window. It is a countdown to impact. The previous defensive standard, established by decades of technological supremacy, afforded the Gulf corridor a 15 to 20-minute warning of an inbound missile attack. This was a manageable time frame. It allowed for asset dispersal, for scrambling interceptor aircraft, for personnel to move to hardened locations. Now, based on the latest CENTCOM briefings, following the destruction of the forward THAAD radars, that window has collapsed to between 60 and 120 seconds. Operationally, this is a distinction without a difference. The time to detect, process, issue a warning, and have personnel react is longer than the time to impact. The air defense system is, for all practical purposes, gone. It has been physically and economically neutralized. This military reality is now colliding with political rhetoric, and the result is a catastrophic loss of credibility. The administration's promised timeline for resolving the conflict has become a case study in failure. It began at an optimistic 6 days. Then it slipped to 4 weeks. Then it was extended to 100 days. The latest projection is now 7 months. Each extension is a public admission of a prior failure and a fundamental miscalculation of the adversary's strategy. When the military reality on the ground, a 120-second warning so blatantly contradicts the political promises from the podium of a quick war, credibility evaporates. This is what a loss of control looks like in the data. Confirmation of this collapse is no longer hidden. It's being actively signaled by insiders. A Pentagon internal assessment, leaked to international media, stated that 25% of US early warning systems in the region have been destroyed. You must understand, this is not spin. This is not a managed public relations narrative. This is a distress signal, a desperate flare sent up from within a system that knows it is failing. The command structure is acknowledging its blindness and its inability to protect its own forces, all while Iran has a clear, publicly stated off-ramp on the table. The conflict stops when US forces withdraw from regional bases, an offer that is being ignored because accepting it would be an admission of total defeat. But here is the critical insight you must grasp. This entire sequence, the blinding of the radars, the bleeding of the treasury, the collapse of the defensive timeline, is not the main event. What we have just analysed is the trigger, not the payload. The real story, the one that will redefine the global balance of power and capital flows for the next generation, is what happens next. It's the story of how America's oldest and wealthiest allies react when they see the empire can no longer protect its own assets. And what they do with their money. What they do with their money is begin a recalibration of sovereign capital on a scale not seen since the post-2008 financial crisis, a pivot whose systemic impact could prove even larger. This is the payload. For decades, the Gulf states operated under a simple, unspoken agreement with American power. They would tolerate American foreign policy in exchange for one non-negotiable asset, a security guarantee. As we have just analysed, that guarantee has now been visibly, publicly, and undeniably broken. The timelines, the cost ratios, the failure to protect high-value assets, this data proves the guarantee is void. For the investment committees of Gulf sovereign wealth funds, this data is not abstract. Degraded interceptor performance and delayed response timelines translate directly into higher risk premiums on US-backed infrastructure. They signal a catastrophic failure in the security of the very assets that generate their dollar-denominated cash flows, forcing a mandate-driven re-evaluation of concentrated US exposure. This broken deal is now cracking the bedrock of American economic supremacy. The Petrodollar recycling mechanism. The system's design was a masterstroke of financial engineering. Step 1. Gulf nations price and sell their oil to the world exclusively in US dollars, creating immense, constant global demand for the currency. Step 2. They accumulate vast surpluses of these dollars, petrodollars. Step 3. Instead of converting them, they recycle them back into the US financial system, primarily by purchasing US Treasury bonds. This final step is the linchpin. It created a captive, price-insensitive buyer for US debt, which for 50 years has allowed the United States to fund its massive structural deficits and project military power at an artificially low cost. It is the financial engine of the empire. That engine is now seizing. The failure to provide security is forcing America's most critical financial allies to fracture that final step in the recycling loop. The evidence for this is not speculative. Reports from both the Wall Street Journal and the Financial Times confirm it. The sovereign wealth funds of Saudi Arabia, the UAE, and Qatar are conducting full-scale reviews of their US holdings. These funds manage a combined total of over $5 trillion, and they are now invoking their rainy day mandates. These are not informal guidelines. They are strict governance protocols designed to preserve national wealth when core strategic assumptions, like an ironclad US security guarantee, are invalidated. The Economic Times captured this shift with clinical precision. Gulf sovereign wealth funds were built for a rainy day. This may be it. This is far more than a tactical portfolio adjustment. It is a structural pivot, defined by changes to the core mandates and benchmarks that govern these trillions. Initial signals point to permanent allocation bands being established for non-USD assets like gold and the yuan. and a clear reported strategic shift away from long-duration US paper towards strategic industrial holdings primarily in Asia. This constitutes a fundamental rejection of the system that finances American overextension written in the cold calculus of capital allocation. We have now established the geopolitical cause and the macroeconomic effect. But when the largest, most reliable buyer of US debt steps away from the market, it creates a vacuum. That vacuum forces the US to either offer much higher interest rates to attract new buyers or have its central bank print the difference, mechanically driving up treasury yields and inflation. The most critical question remains: what are the specific, tangible consequences for those numbers and for the assets inside your own portfolio? That is precisely where we are going next. The consequences manifest first in the US bond market, the foundation of the global financial system. Immediately following the strikes, financial markets sent a clear signal. Contrary to the typical flight to safety during a crisis, where treasury yields would fall, the 10-year yield spiked, with CNBC and the Wall Street Journal reporting a range of 4.044 to 4.117%. This was not a system malfunction. It was the market pricing in the twin realities of an oil-driven inflation shock and the fiscal cost of a protracted attritional conflict, the math of American overextension made tangible. The causal chain from military attrition to fiscal pressure is direct. First, replacing depleted high-end interceptor stockpiles is a 3 to 8 year industrial process, based on CSIS and GINSA analysis. This long-tail replacement cycle necessitates massive, unfunded budget allocations that persist over multiple fiscal years, guaranteeing elevated treasury issuance for the foreseeable future. To fund this new debt, the Treasury must attract capital. This comes at a time when major foreign holders, like China and Japan, have already been net sellers of US Treasuries, fundamentally altering the supply-demand calculus. The consequence is simple. The Treasury must offer higher interest rates to clear the market, pushing yields higher across the curve. These sustained higher yields are not an abstract variable. They reprice the entire domestic credit landscape. A persistent 100 basis point rise in the 10-year yield translates directly to higher rates for 30-year fixed mortgages, effectively freezing housing market activity. For corporations, it raises the cost of capital, making new bond issuance more expensive and thus delaying investment and expansion. For the individual investor, the damage is threefold. First, the market value of existing fixed income holdings falls as prevailing yields rise. Second, the purchasing power of fixed coupon payments is systematically degraded by the very inflation the market is pricing in. Third, cash and near-cash holdings hemorrhage value in real terms as their returns fail to track the consumer price index. While US capital is diverted to managing this attrition, global competitors are reallocating assets based on the emerging data. Russia is securing long-term energy contracts, with India and China selling its Urals crude at a persistent discount to Brent to lock in market share. More structurally, China is accelerating the de-dollarization of commodity trade. We are seeing a measurable increase in Russian and Gulf state oil sales settled directly in yuan, bypassing the SWIFT system. This is not a theoretical scenario. It is an active, observable shift in global capital flows. This new reality necessitates a recalibration of portfolio defenses. 3 specific risk channels require mitigation. First, to hedge against sustained inflation, eroding real returns, investors reevaluate instruments like Treasury inflation-protected securities, or TIPS. Second, To counter the correlation between conflict and supply chain shocks, selective exposure to hard commodities becomes a relevant tool. Finally, to insulate against the long-term degradation of dollar primacy signaled by these capital flow shifts, a partial strategic diversification into non-USD denominated assets is no longer a fringe tactic, but a core component of prudent risk management. This repositioning is not a temporary market correction. It is the final data point confirming a permanent shift in the global balance of power. What we have witnessed is a complete, interlocking causal chain. Let us retrace it with absolute clarity. First came the blinding. The surgical removal of America's key radar systems was the critical first move. It created the fundamental vulnerability by blinding the central nervous system of its entire regional defense architecture. Then came the bleeding. With the system compromised, a calculated war of economic attrition was launched. This exploited the vulnerability by forcing the United States into an unsustainable fiscal hemorrhage, inverting the cost curve of modern warfare, and exposing the brittle reality of its industrial base. This military and economic failure triggered the pivot. The flight of capital by former allies was not an act of betrayal. It was a rational, data-driven reallocation away from a system displaying clear signs of terminal overextension. The blinding, the bleeding, and the pivot. These are not disparate events. They are a sequence, a fatal logic chain that has resulted not in a temporary setback, but in a permanent recalibration of global influence. The United States is left weakened, and its rivals are empowered to shape the new reality. What we have mapped in this analysis is a framework. It proves that military degradation and production timelines are no longer niche topics. They are the primary leading indicators for macroeconomic shifts and capital flight. If you want to stay ahead of these shifts and protect your assets with analysis grounded in the cold, hard data of logistics and sovereign balance sheets, then make sure you subscribe and activate notifications. You will receive intelligence, not headlines.